I'm going to start with an area that you probably wouldn't think about in looking at it, and that's demographics. For example, if you were to take the UN data concerning demographics, for the globe over the next 25, 30 years, it'd probably shock you the way it shocked me to discover that Nigeria will be a much bigger country than Germany, that Afghanistan will be a much bigger country than Italy, that Egypt will have more people than Russia. Now that's almost impossible to believe, but something that we did just to kind of cross-check what the demographers were showing was we took the old Soviet Union, which was, I think, composed of something like 23 countries, and we broke it down into those countries that were in the Western world and those countries that were in the Eastern world, which kind of breaks down to the Christian countries and the Muslim countries. And what you see is that all of the Christian countries are projected to see declines in their population between now and the year 2050, or some of them, are likely to have flat populations. All of the Muslim countries, or the countries in the East, are expected to have substantial growth in their populations. Now, to me, the issue that I'm going after is the cost of labor. Because if a nation, for example, the Congo, I mean, to really get wild on this stuff, you got a country like the Congo, right, which basically has constant turmoil, constant civil war, massive poverty, and yet the birth rate per woman is up over 8, and the growth in the Congo's population is so strong that, supposedly, according to the United Nations, in the year 2050, there will be 3 times as many people in the Congo as there are in Great Britain. So what that says to you is that there's going to be an ever-ending supply of very cheap labor. And cheap labor, for example, the figures that I have on the cost of labor in China are somewhat outdated. But if you go back 5 years ago, which is where my figures come from, the average worker in China was making $3,000 a year. All right, it was making $3,000 a year, which is 1/10 of what the average worker in the United States was making at the same time. So the net effect is what happens is you produce very low-cost goods in these countries, which have this unending supply of cheap labor, and those goods are sold globally. So how does that work? Let's assume that someone in this room buys a Toyota, and not one made in the United States, one made in Japan. What happens is you send $40,000 to the Toyota manufacturing company in Japan, and of course the Toyota manufacturing company can't do anything with the dollars, so they put them in the Mitsubishi UFG bank and they swap them for yen. Well, the bank can't do anything with those dollars either, so they give them to the Bank of Japan, again swapping it for yen. So the fact is that because you bought that Toyota, you increase the money supply of Japan, and you put a big chunk of funds into the Bank of Japan, a big chunk of dollars into the Bank of Japan. Now, if we take the country that has the biggest trade surplus with the United States, which would be China, and we took a look at what is happening to the trade surplus there and what the impact is on the reserves in that country, what you will find, and to look at one country to another, on an apples-to-apples basis, let me step aside for a second, you have to figure out a price of gold. For example, the United States values gold and its reserves at $42.50, and the Chinese value gold in their reserves at $200 an ounce, and the Indians value gold at $100 an ounce. So let's assume we make the value of gold $1,000 an ounce for each one of these countries, and we calculate their reserves going back over a 25-year period. What you find is that in 1990, the United States had 20 times the reserves that China had, and that today, China has 4.6 times the reserves that the United States has. So in essence, what we've done, because of this massive population growth, this extraordinarily low cost of labor, this big increase in the trade surplus in China, is we've shifted this huge amount of money, the biggest wealth transfer that has ever occurred in peacetime, to China from the United States. All right, now the impact on China and the United States is different in two senses. In the United States, because we're not producing things that we're selling globally. We borrow the money, we print the money, we borrow the money to buy the goods which China is selling us. In the case of China, because they are producing things and they're sending it here, they develop this massive surplus. And now China has a big problem, right? The big problem is that 65% of the backing of the yuan or the renminbi, whatever you want to call it, is in dollars and US treasuries. Because I left out one step in this Toyota thing, because when the Bank of Japan gets these dollars, what they do with the dollars is they buy US treasuries and they fund the deficit in the United States. But the net effect is, if you have $2 trillion in reserves, which is what the Chinese have, that you can't buy enough treasuries. And it's imprudent to buy treasuries, because if you continue to buy treasuries, not only will 65% of your assets be backed by the dollar or treasuries, but it'll start to get to be 75, 80, 90%. And by the way, that's the reason why the Chinese are not going to do anything to destabilize the dollar, because if they destabilize the dollar, they ruin their own currency, because their own currency is backed by the reserves, which are in fact, the dollar. It is also the reason why a few years from now, the dollar is no longer going to be the world's reserve currency, because all of these countries understand the issue. They all understand the issue, which is that they can no longer back all of their reserves on dollars or treasuries, and therefore they've got to shift away from it. And that's why gold is going up, and you saw the Central Bank of India buy all this gold a couple of days ago, or maybe a week ago, I forget when, and even Mauritius, which is this little island off of Africa, they're buying as much gold as they can buy also, because they don't want to use the dollar anymore. But they know they can't get off the dollar quickly, so over an extended period, and I think it's going to be 3 to 5 years, they will shift, and there will be a new reserve currency in the world. But I don't want to, because we're talking about banking, I don't want to go down that path at the moment. The issue is, we now have $2 trillion worth of reserves sitting in China, and China has to invest that money somewhere. The guy who has money, in a sense, has a bigger problem than the guy who doesn't have money, because the guy who doesn't have money doesn't have to worry about what he's going to do with the funds. The guy who has money has got a lot of problems trying to figure out what to do with those monies. So what did they do? Well, first, obviously, they put the money into treasuries in the United States. Then they started expanding beyond treasuries, looking at high-grade bonds. Then they started buying physical assets like real estate. But along the way, Wall Street kept coming up with these new investments for them to make. They came up with collateralized loan obligations. They came up with collateralized debt obligations. They came up with credit default swaps. They came up with, commercial mortgage-backed securities and residential mortgage-backed securities. There was this massive explosion in innovation in Wall Street to come up with instruments that the Chinese, the Indians, and the other holders of funds could purchase. So the next problem that occurs is, if you're funneling this huge amount of money into these new instruments, there's got to be someone who wants the money. And, hard as that may sound, it is very difficult to find someone who's going to eat up $2 trillion. And the real estate industry in the United States seemed to be a place which would absorb this huge amount of funds. And as a result, we started pouring money into real estate. But, we run into a problem there, because this is the first time in the United States that we've had a boom in residential housing, and the population of people 25 to 35 is going down. In other words, we've had booms in real estate in I think it was 1906, 1926, 1950, 1972, 2005, right? Every one of those prior, booms in real estate were created because there was this growth in the population of this country, and that growth in the population, when it hit, the house buying age, resulted in this boom in purchasing housing. This time around, that group of people were declining in size. They were actually shrinking in size. So the net effect is the creators of these residential mortgage-backed securities, which became, the CLOs, the CDOs, and CDO squared, et cetera, they had to keep stretching lower and lower to find people to buy these houses. So they came up with these negative amortization loans. They came up with these, interest-only payment loans. They came up with going into the subprime market to find people who couldn't qualify for these loans, but they gave them the loans anyway because the Chinese had to invest the money. So what happened, by 2006, yes, it is a joke. By 2006 or 7, what happened is you were growing debt in the United States 3 times faster than you were growing income. Ultimately, if you grow debt faster than you grow income, you will have a collapse. So that, there's a guy named Hyman Minsky who died 10 years ago who exactly predicted this collapse. There's another guy named Charles Kindleberger who wrote this book, Panics, Crises, and Manias, which I strongly recommend that you read, who also died, well before this collapse occurred. But the theories that these men, came up with as a result of looking at, these events where you expand, debt faster than you expand income, correctly predicted that there would be collapses, although they weren't thinking of 2007 or 8 in the United States. All right, so now you got this collapse. And now the banking industry has got a real problem because people can't afford to pay for the instruments that have been created. The instruments are failing at a rapid rate. And all of a sudden, confidence in the banking system gets pulled. And as a result of confidence in the banking system getting pulled, what we saw in the 4th quarter of last year, a run on the banks. It wasn't a run on the deposits because remember, the deposits are guaranteed by the US government and depositors didn't pull their money out. They didn't pull their money out in 1990 either. They kept their money in. But the problem this time around is the banks had restructured their balance sheets so that they were funding their incremental growth with debt. And you could have a run on debt because debt was not guaranteed by the US government. You did get a run on debt. And the second problem that occurred was that the banks, because they were trying to maximize the return on their investments, stopped holding cash, stopped holding securities backed by the United States government, and decided to hold securities that were basically AAA rated or asset-backed securities that were privately guaranteed, not government guaranteed. The net effect is when the run on the debt occurred, these banks couldn't sell these assets. There was no market for them. And if they did sell them, they were getting 20 cents on the dollar, so they weren't generating enough funds in order to, pay off the run on the debt. All right, the third problem that existed was they couldn't utilize their loan portfolio to stop the run because they had downgraded the quality of the loan portfolio by issuing a large amount of these negative amortization loans and a large amount of these payment-in-kind loans to businesses, which you don't hear quite as much about, but there is much of a problem. So the net effect is we had a situation when the Congress stepped back and looked at it. They said, too much debt in the banks caused this problem. Too much, if you will, not too much, but too little liquidity. Too much bad lending because of the weak products that they put out. And fraud and mismanagement. So now, Congress has got to deal with the fact that the population is furious, right? The population is so angry at the banking industry in the United States that they want legislation, and they want a couple of things to happen. Number one, they want to punish everybody who was involved in causing the situation, which is why Goldman Sachs is putting out $500 million to small businesses. It's a public relations gambit, right? But the point is, there is a strong demand on the part of the population to get these people punished and to make sure these people don't benefit by anything that the government does from this point forward. There is also a strong demand on the part of the population, to basically stop these things from happening, to stop, these collapses from occurring, to create safety and soundness in the banking system. So what the Congress is now doing is it's not looking at the root causes of what this problem was, which is essentially that we were not producing goods that were sold globally, and therefore these huge pools of money were created. The Congress is not creating, job incentives for companies, where you get a tax break if you hire people. They're not creating incentives for capital expenditures. They're not creating incentives for investment. What the Congress is yelling about is we need more debt. The banks aren't lending enough money, and we need more social services to purchase so that the consumer will buy more things. And maybe one look at the health care bill would be that it increases consumption of a product that we sell a lot of, because if you take a look at the numbers, there are more people working in health care in the United States than all of the manufacturing activities in this country put together. The second biggest industry that utilizes labor in the United States is retail sales forces. So that, people who work at Macy's. I mean, so the net effect is, if you take a look at health care and retail, that's over 20% of the workers in this country, and manufacturing is only 9%. So the net effect is we're pushing on what we think is the right thing. We're pushing to get, more consumption, and we're pushing to get more debt to fund more consumption, even though that's exactly why we're in this pickle in the first place, i.e. too much debt and not enough production. All right, but we're not going to do anything about that because Congress just doesn't see it, doesn't understand it, and they're not going in this direction. What they do see and what they do understand is that there's too much fraud in the banking system, there's too many excesses in the banking system, and they know how to do something about that. So what are they going to do? The first issue I said that caused the problem in the run last year was the banks had too much debt. They were borrowing too much money to fund the growth in assets. So what Congress is doing is it's forcing the banks to fund themselves with capital and deposits. They've got to shrink the debt that they utilize, because if they don't have debt, then nobody can have a run on the debt. All right, the second thing that the Congress is doing is they're looking at this other issue, which is there was no liquidity in the system. And because there was no liquidity in the system, there was no ability to pay off the run when it occurred on the debt side. So right now, if you pull the balance sheet up of J.P. Morgan, you'll find that they've got $85 billion in cash on their balance sheet. And if you take a look at their securities, you might argue that they've almost got $500 billion in liquidity on that balance sheet. If you look at Bank of America's balance sheet, it has $165 billion in cash. And when I say cash, I mean cash. And it's cash is money that they deposit at the local Federal Reserve. And the reason why you know it's there is because before this crisis happened, there was $10 to $12 billion in excess reserves at the Federal Reserve. And now there's $860 billion in excess reserves at the Federal Reserve. And excess reserves are nothing more than cash deposits made by the banks at the Fed. Citigroup has got $260 billion in cash on its balance sheet. All right, so the second solution was get these balance sheets liquid, because if there's going to be a run on the bank, if the balance sheets are liquid, we can pay for it. All right, the third thing that they want to do is that they want to get rid of the high-risk lending that the banks involve themselves in. And the solution to that problem is to basically increase the reserve requirements against risky loans, so the banks will find it uneconomic to make them. In other words, if you tell a bank, your reserve requirement against a fixed-rate mortgage on a single-family home is 10%, and I'm just pulling that number out of the air, and you tell the bank that your reserve requirement on a credit default swap is 60%, then all of a sudden it's just not economic to get involved with a credit default swap. You have to make fixed-rate mortgages. So what the Congress is doing by reshaping the risk weightings put on these different assets is it's reshaping the lending of the industry. All right, now the fourth problem, remember, was the fraud problem. And what they're doing there is they want to set up this Consumer Finance Protection Agency. And the Consumer Finance Protection Agency is going to slow down price increases in the banking industry. In other words, like the credit card bill, it may come along and say, you can increase prices a couple of times a year, and when you increase prices, you can increase prices a certain percentage point, but not above that percentage point. All right, so if all these things go into effect, and I really strongly believe that all of them will go into effect, will this increase the safety and soundness of the American banking system? Absolutely, no question about it. It will definitely increase safety and soundness, and it will definitely reduce, you know, the numbers of problems that arise from the system. But what are the unintended consequences? Well, the first unintended consequence is that this costs an awful lot of money. You know, if the banks are going to have these reporting functions, if they lose control over pricing, if they lose control over the timing of adjusting pricing, then somehow they've got to get that money back from someone, somewhere, and the person they're going to get it back from is the consumer. If you've noticed in your mail, you probably have gotten a letter from every one of your credit card companies telling you that the max rate on that credit card is now 30%. And that so infuriated Congress that they said that this credit card bill, instead of going into effect in the middle of next year, will go into effect December 1st. All right, the second thing that they've done so far, even without the bill being passed, is this overdraft issue, which is great, you would think, from the consumer standpoint. You can't increase the overdraft fees. You can't charge more than 4 overdraft fees a year. The problem is that if you change the overdraft function, 30% of the accounts, and I've checked this with numerous bank consultants and banks, so even though I can't give you the exact numbers, 30% of the people who have accounts in banks in the United States will be unprofitable to the bank. And what's the bank going to do? It's going to kick them out. It's going to start firing customers. It's what they did in the 1990s. In the 1990s, there's a bank consultant, a guy named Jim McCormick, who runs First Manhattan, which I think is the best bank consulting firm in the country. Excuse me. What McCormick did was he said, we got to get rid of this 80-20 rule. 80% of your customers are creating 20% of your profits. What we've got to do is make those customers profitable. And the way we're going to make those customers profitable is we're going to jump the costs of banking for those individuals. So the net effect was hundreds of thousands of people left the banking industry. You remember the stuff in the paper, if you want to see a teller at First Chicago, you got to pay $2. If you visit a Bank of America branch more than 3 times in a month, you get a $1 statement charge. So in essence, we're going to go back to that. We're going to go back to a system where the banks are jumping the prices of consumer finance, and we're going to force, I'm going to tell you, millions of people out of the banking system. That's an unintended consequence that they're not thinking about. Another unintended consequence is they can't lend money. You can't raise capital and raise liquidity and at the same time make loans. It just doesn't work. There isn't enough money sitting on that balance sheet to allow you to do that. So the net effect is what you're doing in this situation is you're basically creating a situation where the banks can't lend the money. The third thing that you're doing, which is an unintended consequence, is talk too long. All right. One final point, all right? And that final point is that the last unintended consequence is that you're shrinking the American financial system as a percentage of the world financial system. You're weakening our financial power because in 1945, 100% of the currency in the world was the dollar, right? Today, there are more euros outstanding than dollars. There are more yen outstanding than there are dollars. Dollars are only 19% of the world's currency. If we shrink our banking system, which is what we want to do, we get back to where we were in 1990, when the biggest bank in the United States was Citicorp, and that was the 22nd largest bank in the world. And President Bush at the time and Treasury Secretary Brady at the time basically indicated fairly clearly that this was inhibiting the growth of American corporations around the world. So net of what I'm saying to you is that I think the Congress is trying to solve the wrong problem in the wrong way. It's moving the banking system in the wrong direction, and every one of us are going to see negative impacts on our cost of doing banking and the ability to grow our businesses as a result of what's being done. And I apologize, I'm just talking too much. Okay, thank you.